Welcome back. It's Bobby, and today we're going to dig into your accounts and talk about the mother of all subscription fees. If you invest in mutual funds, this fee may not even hit your radar. Most investors believe they don't pay any fees at all, and the ones that do couldn't tell you how much they pay. So in this video, we're going to explain how mutual fund fees work and answer these 3 questions. Who does the fee go to? Why do I even have this fee? And what are my options? This is going to sound obvious, but what you save in fees, you get to keep. Let's go. Mutual funds provide an important part of investing 101. The vast majority of investors are in what we call balanced funds. And this is just a mix of stocks and bonds, typically 50 to 70% stocks and maybe 30 to 50% bonds. This is what we call asset allocation. It gives us a bit of a smoother ride because when stocks are up, bonds might go down and vice versa. The portfolio manager also provides some other key things such as diversification, rebalancing, and the simplicity of being able to invest smaller amounts, let's say $25 to $100 a month into your account. Of course, they charge a fee for this service. They're not doing it for free. This forms part of what we call the management expense ratio, or MER. The average balanced fund in Canada charges about 2.2% as an MER. And let's break down that 2.2% into some very key parts. For the portfolio manager and their services, they'll take about 0.9%. And then there'll be operating costs as well as taxes on top of that. Let's say that's gonna be 0.3%. Now the other 1% is gonna go to your advisor's firm. This is commonly known as the trailing commission. The trailing commission is for the advice and services of your advisor and their firm. If the advisor is not a salaried employee, then typically the trailing commission is split between their advisor and their firm, let's say 50-50. If your advisor is on salary, let's say they work for a major institution such as a bank, then the bank actually keeps that entire MER, the 2.2%, and then splits it into its various subsidiaries. Now let's quickly summarize. The management expense ratio, or MER, is 2.20%. 1.2% of that goes to the fund company. 1% goes to your advisor's firm, and this is called the trailing commission. Your advisor would get a portion of that 1%, or they were paid on salary. But that's not all. There is something called a trading expense ratio, or TER. This is an additional cost for buying and selling securities within that fund. This is shown as a percentage and can be 0 to 0.2% each year. For example, let's just use 0.1% for ease of math. This means now your total cost of investing is actually 2.2 plus 0.1, which is 2.3% of your balance every year. If you invested $10,000, that would be $230 in fees. If you invested $100,000, now that's $2,300 in fees every year. If you invested $200,000, that's $4,600 in fees every single year. So you get the idea. As your balance goes up, your fees go up as well. Now, if you don't believe me, you can look at the document called the Fund Facts. This document summarizes the particular fund and the fees associated to investing in that fund. Your advisor is supposed to go over this with you and translate the percentages into dollar terms as well. So how much am I paying? You can find the MER on the fun fact at the very top of the first page, and then on page 3 or 4, you'll find the TER, the trading expense ratio. The fund expenses is the sum of the MER and the TER, and that's added up for you. Now this is the part that's really confusing. At the end of the calendar year, you receive your statement and it's supposed to summarize the fees that you paid to invest. But they don't even show you the whole fee. They don't have to. The figure that they're showing is actually only the trailing commission. So thinking back to our example, that was only the 1% of the 2.30% we illustrated. So whenever you're looking at your year-end fees, just remember that's probably less than half the fee that you're paying. And this has only been a recent thing that the securities regulators required the fund companies or the dealers to show in 2016. So before that, investors didn't even know potentially what they were paying in fees. There's another set of fees called sales charges. You may have heard of them. I'll be discussing the most concerning one. This is called the deferred sales charge, or DSC for short. They are sometimes also called back-end loads. These deferred sales charges require the investor to stay with the fund company for upwards of 6 to 7 years. And if the client decides to change fund companies, then they are charged a fee, hence the name deferred sales charge. This fee can be as high as 5 to 6% of the amount and reduces over time to zero. Your advisor's firm receives 5% of the amount invested upfront as a commission, and then the entire balance is invested. So if you leave early, the fund company recoups its commission. In addition, the advisor's firm also receives a trailing commission, but typically this is reduced by half. As of the posting of this video, securities regulators are trying to eliminate the DSC structure. This is partly because there's an inherent conflict of interest to use particular fund companies in funds because of the incentive for DSC. The DSC also restricts the investor's choice and flexibility if they wanted to change their mind. In other words, it is not in you, the investor's best interest. If you're considering using DSCs, ask the advisor if they have the non-DSC version, or I would suggest looking for a different advisor. At this point, you may ask yourself, why do I care? Many advisors will explain that fees don't matter if your net return, which is the rate of return after fees, is positive. This is theoretically true. However, there are two things that mess up this line of thinking. Over longer periods, such as 10 to 15 years, actively managed mutual funds don't beat their benchmark 2/3 of the time. In a worst case scenario, 95% fail to beat their benchmark. And the 5% that do, you can't figure out or determine them in advance. So alternatively, you could invest in index mutual funds or exchange traded funds, sometimes abbreviated ETF, to get very close to the benchmark rate of return. These funds, especially the ETFs, typically have much lower fees, around 0.25%, which is a lot less than your average mutual fund, charging 8 to 10 times as much. All this together means more money back in your pocket. You may be thinking to yourself, do I even need an advisor? Advisors have a critical role in helping investors with their financial decisions and growing their wealth. An excellent advisor will clearly present their compensation and as well as provide relevant and appropriate advice. However, when faced with similar investment choices, a reasonable person would take the lower cost option. If you're not sure where to get started, or you just want to review your situation and make sure you're on the right track, sometimes hiring an advisor is the best thing for you. Tips for finding the right advisor. Are they transparent about their fees? Are they independent or tied to a specific fund company? Do they have embedded commissions such as an MER, or are they fee-based where you can see the dollar amount? What's their philosophy about investing? Do they offer low-cost options such as ETFs or index funds? Do they work with robo-advisors or self-directed accounts? Can they offer a flat fee or a retainer compensation? These hybrid fee models where the advice is separate from the investment solution are becoming more and more common in Canada, and I personally feel that they're the best choice for consumers like yourself. As you become more aware of how hidden costs in investments are being charged in investment companies and banks alike, I'm sure you'll agree. Now, in closing, next week we'll be putting out a video explaining the hybrid fee model. So you want to make sure you come back to check that out, or subscribe to the channel and then you'll get alerted with a notification when we upload the video. To wrap things up, fees matter. They can and will erode your wealth if you're not careful. Be aware of what you are paying. Make sure your advisor is transparent about their compensation. And if it's right for you, work with an advisor like myself can help you lower the cost of investing. So if you have any questions, send me a note or make a comment down below. And if you found this video valuable, remember to smash that like button. Subscribe if you haven't done already. Thank you so much for watching once again. It gives me so much juice to keep on producing these videos and helping Canadians like yourself. And we'll see you in the next video.